Hello, I'm Marcus Brix with the CattleFax Closing Bell. Today's Closing Bell is sponsored by CattleFax, the deciding factor. Crude oil futures opened the shortened holiday week, trading at their highest values since fall 2014. Concerns of global petroleum supply capacity are combining with escalating geopolitical issues to increase market uncertainty. U.S. crude oil usage was mostly flat during the recent wave of Omicron cases, holding 1% above the 5-year average. Average new U.S. COVID cases have dropped 9.5% since January 15th, as it becomes more and more likely that cases have peaked domestically. Supply growth will now become key to reining in energy inflation. OPEC and their allied countries raised supply targets by 400,000 barrels per day in December, but actual production increases only amounted to 170,000 barrels per day. The International Energy Agency forecasts spare OPEC Plus capacity at more than 6 million barrels per day from December levels. Converting this capacity into production will require additional capital investment and increased labor costs. Production gains will also need to narrowly dodge geopolitical disputes, such as drone attacks and pipeline bombings in the Middle East, as well as a potential invasion of Ukraine by Russia, the world's second largest crude oil producer. More than 100,000 Russian forces have been stationed at the border, and over 100 warships have been deployed in the Black Sea as a display of force. Russia has been openly at war with Ukraine since the 2014 annexation of Crimea. In past conflicts, Russia has used the distraction of the Olympic Games to make territorial moves, namely Crimea in 2014 and the invasion of Georgia in 2008. The 2022 Winter Olympics begin February 4th and continue through Feb 20th, which could imply a narrowing timetable for de-escalation. Several weeks of talks were fruitless as reaching a diplomatic solution, as Russia continues to make unagreeable demands to NATO. While Ukraine is not a NATO member themselves, this week allied countries have provided weaponry, warships, and support troops to the country, hoping to force a stalemate of sorts. Situation remains in a fragile balance, but an advancement from Russia could have ripple effect on multiple commodities. Russia is a primary oil and gas supplier to Europe and provides roughly as much oil to the U.S. as we currently receive from Saudi Arabia. Ukraine is a major global grain producer, providing some 16% of the world's corn exports and 12% of wheat exports. Supply disruptions in either country or further economic sanctions against Russia increase market uncertainty and open risk to higher average prices. Spot WTI crude is up $1 per barrel this week after moving $5 per barrel higher last week. Spot corn futures were up 20 cents per bushel this week. Spot KC wheat futures were up 55 cents. Spot soybean futures were up 59 cents, or 3%, compared to soybean oil, which was higher by 8%. Live cattle futures finished the week nearly unchanged, up 10 cents per hundredweight in the spot February contract. In the cash, fed cattle traded in the South at $137 per hundredweight live, mostly $1 better than last week. Fed cattle also traded in the North at mostly $137 live, which was steady to $1 softer than last week for that region. Thanks for watching. Remember to visit CattleFax.com to become a member, see the latest market news and analysis.